let's sort of pair it back to, because we're kind of pure growth investors, and it's almost coincidental that Christoph and I sometimes own stocks that pay a bit of a dividend, but we're really looking at like earlier stage companies. Like, how would, like, maybe try and persuade our listeners, like, why is owning dividend paying companies also a kind of profitable, beneficial strategy as an investor?
Yeah, and I think what we need to maybe land on first, like what's the ultimate goal of investing?
Hmm.
Yeah. So for some people, the ultimate goal of investing is to have the maximum total return out of their money invested. For me, it's not. For me, it's replacing my hard-earned income that I put a lot of sweat in by passive income. Let's call it like that. For that, you have multiple strategies. You can do dividend investing or dividend growth investing in my case. You can do real estate investing and such. So it's really important to know that I'm not focused on total return, but I can tell you that total return is typically an outcome of also of my investing style, or a good outcome. And there are enough statistics actually about it when you think about dividend growth investing. And I will share maybe a picture with you as well, where it's clear that dividend growers and initiators are outperforming by a wide margin all other companies with other dividend policies. So just dividend payers, that if you think about, I have a picture here in front of me from 1973 to 2023, are maybe only 60% of the total performance compared to the dividend growers. And then you have the no change in dividend policy that effectively do nothing. They are really lower. I always say in this, like, it's a market of stocks. It's not a stock market. So we should not generalize on this. But I do think that dividend growth companies, they are typically very cash rich. So if you think about capital allocation, think about Google, Microsoft, Facebook, because for instance, Meta and Google recently started to pay a dividend. I think there are two reasons for it. At a certain moment, you earn so much cash that you may not be able to reinvest it anymore in your business with a certain amount of return. So that's better to just give it back to the shareholders so that they can reinvest it elsewhere at a better rate of return. Or maybe in Meta's case, it is much easier for Zuckerberg probably to get a dividend than to borrow money against his shares. Yeah. So what I would like to say is, like, for me, it is much easier to predict if a company can grow in the next few years for a little bit more the established companies, the blue chip companies. I often understand their products. These are slow compounders, and it's really important. I'm a big fan of slow compounders. Slow compounders for me are companies that take like 15, 10, 15, 20 years to build a business slowly because of the market dynamics. It's really hard to compete against them at a certain moment. Think about Amazon, a perfect example of a slow compounder. It's not easy to just beat Amazon at their home turf, right? And start taking market share from that. The same with Microsoft, but the same with Unilever, the more classic dividend growth stocks that we're talking about. So for me, they are much more predictable. There are enough warning signs if these companies are starting to turn south. And it makes it much more easier for me to analyze, to understand the business, and to kind of predict a little bit, because we're all in the business of prediction here. What is the likelihood of the company doing better, let's say 5 to 10 years from now, than where it is today? So that's where my character comes in, that I find it easier to analyze. And that's why I'm not so much in the early stage. But I guess the risk and reward is also different. I think making a 10 bagger with Microsoft is a bit hard at this stage of the journey. Though I think people would have said the same in 2014 when I bought the stock at 40 and now it's a 10 bagger. So you never know how a stock still evolves, but I can tell you it was not in my predictions at all with Microsoft at that moment in time. It's just one of those companies that blows up in your portfolio that you think like, okay, I sound smarter now than I was in reality at that time.
Yeah, Edgy, I loved a couple of definitions you just threw out, that what the business that we're in is the predictions business. That's an interesting frame, which is true, especially when you correlate it with risk. I want to ask you one follow up about this broader question of what is investing. I think Luke and I always talk about investing as something that is a personal journey, and it sounds cliched. Every time I say it, it sounds almost like a Hallmark card, but I think it's a cliche for a reason because there's so many variables in each and every individual person's lifestyle and makeup and where they live and who they are, all these things, that there is simply no such thing as an algorithmic one size fits all. And the question I want to put to you is specifically relating to, call it, life cycle stage. Would you say that dividend growth investing, or your style of investing, is more or less loosely applicable across different life cycles, life?
Yeah, I find that hard to answer, Christoph, because I don't like to stereotype a little bit, like when is a, some people say, when you're young you should take more risk, you need to be a growth investor. I much more resonate with your first comment, is that it's personal. So if I go personal here, yeah, I come from a poor family. I had no money. My mother was broke, in poverty, social welfare. Um, we were hammered with debt out of a marriage. We literally were on the Dutch equivalent of food stamps. So if I went to study only because I got a scholarship from the government, if I had to pay like nowadays students for study, I wouldn't have paid for it because I was debt averse. So for me, naturally, a conservative style that is focused on maybe, let's say, boring predictability, cash flow, is just much more ingrained in me. I'm just more averse to risk from that point of view, to make a few bets like Bitcoin and such. Because you could say, from a total return investment, if you want to get the best total return and you look back over the last 10 years, you should throw all your money today in Bitcoin. Yeah, if you think like that. But that's not me. So it's very personal what people choose. And I know people that are my age that are just throwing everything in specs, biotech and everything, because they just like the gambling part, a little bit of it, but they also don't want to wait 10, 12, 10, 15 years for a slow compounding portfolio. So I resonate more with our character styles. And what I always say, don't take dividend growth investing because you hear Derek or me talking about it. Find something that fits your character the most, because you will probably do the best naturally. Yeah, you are not fighting against yourself with such an investment style.
And there are so many benefits from doing that. Like, you essentially get all your research for free because it's something you actually, it's a subject you're interested in. And
Exactly.
if you really kind of, not, I'm going to use the word like believe in, I don't mean like a sort of religious belief, but if you really support the mission of the company, if the company is executing, but the stock is struggling, well, that could be a good opportunity to add as opposed to
Hmm.
panicking and selling. And if you're really behind the mission of the company, it's going to help you stay the course when things become
Yeah.
kind of scary, when your stock prices are down.
Yeah, what we always say in dividend talk, and we are famous for two quotes. One is, you can't borrow conviction. Yeah, in the end, it's your money and you're alone with it, and it is very lonely. And the second one is, bankers are wankers, but that's another story.
He's teasing me. He's teasing me because I'm an ex-banker.
You redeemed yourself though, Badge. You're on the other side of penance.